All right, welcome. Dr. Kenyon Meadows here, alternative financial medicine, and have an awesome guest for us today, Stephen Gardner, financial planner. Stephen and I came across each other's path, and when I was promoting my book, he found it. Thought it was useful, reached out to me, and he's an author as well. Has written at least six books, I believe, two of which I've read thoroughly and enjoyed, and we're just happy that we can spend some time and get to know him better tonight. How you doing, Steve?
I'm doing well. Thank you, Dr. Meadows, for having me on tonight.
Yeah, definitely. So, Steve, first of all, you are a financial advisor. So, talk a little bit about what exactly your credentials are, because there's lots of different credentials out there. And could you just, give a little flavor to that?
Yeah, absolutely. I got into the insurance and retirement planning back in 2003. And I had come off a Christian service mission and needed to make some money and find a wife and got into the insurance industry with Allstate. And, that was my first real exposure to helping people with their money. And as time went on, I got more into the retirement planning side of that. I graduated from the David Eccles School of Business at the University of Utah. And my big focus is helping people to safely get to their retirement goals. So I'm not securities licensed. I've decided not to go that route. I'm a very conservative person. I never want to have the conversation with somebody that, hey, you've lost, 20, 30, 40, 50% of your money. And so my main focus is where can we get a consistent rate of return on our money? And how do we have control of that? I don't want people to lose control because I personally lost nearly 40% of my money in 2008 when the stock market dropped. And it was the first time I really felt powerless and without control of my own destiny. And I didn't like that. And so as I dug in deeper, I started learning about ways to grow your money without putting it at risk, and started learning about real estate, started learning about how the wealthy use life insurance contracts to grow their money tax-free. And as I started working with wealthier and wealthier people, about 52% of my clientele are doctors.
Hmm.
And so taxes is a huge issue, excuse me. And so if I can show a business owner or a wealthy employee or a physician how to grow a large sum of tax-free money and have control of that, that's my bread and butter. That's what I'm doing on a daily basis. I do have access to some proprietary platforms where we can get 6, 7, 8, 9%. I do have access to some alternatives, but my comfort zone is staying in those what we call safe money programs.
So, a couple things that struck me. You mentioned how you're not licensed for securities, and so right off the bat, that strikes me as a little unusual for a financial advisor. So, you do not like traditional equities with stocks and everything. That is not a big push of yours with your clients.
No, no. What I found is usually by the time someone's ready to work with me, they've lost money multiple times, and they're just done with it. And so I've decided not to go that route. I've certainly investigated it. I've had people say, "Hey, you're a sharp guy. You should do this." There's a ton of money to be made in residuals, and I've never really felt comfortable with that. Um, again, I just don't want to. It's a personality thing.
Hmm.
If I can help somebody grow their money 5, 6, 7, 8%, and on the majority of that, never pay taxes ever again, I'm comfortable with that. And that's so. Um, with a lot of my people, they have a traditional stockbroker, and then they have me, and I don't like to badmouth their person. There's certainly a place for the stock market. I absolutely believe that. But there's also a place for just having money that you never want to lose again, and money that you want to take out of this crazy monetary system that we have. I
Yeah.
mean, we're $22 trillion in debt, and at some point, I worry taxes are going to go up. The other thing that I really work on with people is when you work with a traditional stockbroker, Series 7, Series 6 person, their main focus is let's diversify, right? Or if somebody's in a 401k, let's get you diversified over these 4 or 5 options that our company's chosen for you. But the conversation of diversifying your future tax burden almost never happens. And that's a conversation I like to have with people, because I run into people regularly that have well over $1 million in a 401k, and then when I tell them that they still owe about 400,000 of that to Uncle Sam,
Mm-hmm.
it's like punching somebody in the gut.
Mm-hmm.
And I'm shocked at how many people have forgotten that they still owe tax on that money. And so I don't like to be the guy that rips off the Band-Aid, but it has to happen, because anybody that's going into retirement with the majority of their money socked away in an IRA or a 401k or a SEP, they just have to know you still owe that money to Uncle Sam. And the scary thing is, Uncle Sam gets to decide how much of your money he owns.
Mm-hmm.
So before, just after World War II, a lot of people don't realize this, but the top federal tax rate was 92%.
Mm-hmm. Yeah.
There's an interview with President Ronald Reagan. They said, why don't you make more than 2 movies a year? You're handsome, you're a good actor, you do a good cowboy. And he said, well, I make about $100,000 a film, so anything above $200,000, I get to keep 8 cents out of every
Right.
dollar. What's the point of working? So that's really scary. Where you and I that earn well, we're in the upper echelon of the tax bracket,
Mm-hmm.
and that's a hard thing to pay.
Yeah.
But they could certainly go to 40, 50, 60, 70% in the future.
Yeah. So a couple things that stand out to me what you said there. So, again, not traditional equities, and you mentioned the areas that you focus on. Number one are life insurance, which of course is something that a lot of financial planners can offer. But then you also mentioned real estate, which is not something and from my experience and from talking to people, that's not something that most traditional financial advisors advise their clients to go into. Now, the real estate, I mean, I'm sorry, the life insurance conversation, much more than I do, the controversy about, permanent life insurance versus term, okay?
Yeah.
And the conversation around fees and expenses and those being terrible products and everything. Just give a little clarity on, clear up some misconceptions about permanent life insurance and what role you think
Okay.
it might play.
Yeah, absolutely. Well, first of all, there are actually some proper conceptions. So let me start there. If you are buying, let's say, a whole life from a traditional agent whose focus is to sell you as much death benefit as possible,
Hmm.
you may be 12 to 15 years before you're breaking even,
Hmm.
and they are going to make an incredible commission off of you. As you'll learn in Taming Wall Street,
Hmm.
uh, I build everything for maximizing cash value, and I tell people straight up, if you need more death benefit than this, then let's buy you a cheap term policy,
Hmm.
because that's not what this is about. And so uh, for these types of policies, the commission can drop by 75 to 80%. Now, most people don't know this about me until they get to know me or ask, but I used to be a national sales trainer. I would train hundreds and hundreds of agents every single year all across the country. And I ended up going back into private practice for 2 reasons. Um, the first one was I would show people the way to build a proper cash value policy, whether it's an index plan or a whole life, and they would get really excited. The math would make a lot of sense, and they could see that it would help the client. And the first thing that kind of irritated me was about 95% of agents have no idea how to build plans this way.
Hmm.
And the insurance companies don't do any education on it. It's too expensive now to fly thousands of agents in, do these big seminars. And so people don't have the training. So number one, a large percentage of people in my field don't know how to build them the way that I do. And then number two, and this was the sad part, was after years and years of working with hundreds and hundreds of agents, most of them would go back to selling a traditional plan that had high commissions and would take nearly 12 to 15 years to break even. And I said, enough, I'm done. I'll just go, back into private practice. So the plans that I build, they don't have the same types of fees. And most times, depending on your age, we can get to break even within 5 to 7 years. I just wrapped up a 30,000 a year plan for a guy in Texas,
Hmm.
and we're breaking even just after the 5th year, which means if he never wanted to pay into that again, he's done, and he's got this huge lump sum of tax-free money that is an asset.
Hmm.
He can use it to borrow against. He could sell it. I've got a doctor in the San Antonio area. He gets real estate loans using his death benefit as collateral, and there's no risk. The bank ends up taking over as one of the primary beneficiaries. So if this guy dies, they just take over that death benefit. They know they're going to get paid.
Hmm.
So, but yeah, to go back to the fees, it all depends on how you build the plan. And with my focus, it's 100, not 99%, 100% focused on getting the maximum amount of cash value in. And then as people will read in my book, there's over a dozen real life examples from my clients, people that have bought airplanes for their business, tow trucks, dental equipment, bought and flipped real estate, rental properties. So once you have that money built in, you have full control of that money, and now you can earn interest in two places at the same time. But so the misconception is, it's not really a misconception, it's a proper conception, because if these plans are built for maximum death benefit, then that's what it's going to do. But when you do it that way, it's built for maximum commission to the agent as well.
Hmm.
And so if whether somebody works with me or somebody else, if you don't want this plan for maximum death benefit, then it needs to be proffered in a very specific manner so that it can be used like a tax-free bank
Hmm. Yeah.
that you have control over.
Yeah, my conception when I studied this in preparation for buying my policy was that cash value life insurance, it doesn't really fit neatly into the insurance investment asset. It doesn't tick one little box. It potentially can tick multiple. And as you know, most people, their level of financial sophistication, even a wealthy, high income professional, it takes some education to get your head around all of it, and then to actually utilize it for all that it's worth. In my case, I actually did borrow some of my cash value out to help purchase a rental property. So, I have used it in that regard. I certainly keep it in the back of my head as something that I can use, and I do sock away some extra money in it. I didn't buy the biggest policy that I could, because I know it's a huge commitment. Like, once you buy it, you're kind of stuck. You got to live with it. So, but I've been happy with it thus far. But I think I'm unusual in that it wasn't sold to me. I kind of researched it in the context
Yeah.
of just trying to get my financial education together and made the decision to buy one. So,
Yeah, yeah, no, and I think that's the way that it should be. Anybody that works with me, I'm a no pressure guy. I tell people all the time, I will go into great detail and explain this for as long as you want. But at no time are you going to feel any pressure, and people either move forward and become clients, or we part ways as friends. It either makes sense or it doesn't. And it's not a place that people would want to put 100% of their money, though
Mm-hmm.
I am confident that they could. But yeah, they've got to be mindful of the fact that there is some cost to that life insurance,
Yeah.
because if they die, then the insurance company is definitely on the short end of the stick,
Mm-hmm.
right? Especially in those first few years. But a lot of my wealthier clients, a trend that I'm seeing is they will do a bigger policy, but will only commit to dumping money in for 7 to 10 years,
Mm-hmm.
and then after that it's done.
Mm-hmm.
And they just know that they have this asset that they can dip in and out of as they need to, but it's not something that they're committing to for 100 years,
Mm-hmm.
like a traditional plan, or 120 years, or even until retirement. But, the majority of people that I work with, they are going to pay in until they're 65 or 70, and just let that thing slowly build, like a Roth IRA, where they're legally avoiding taxes. But there's a significant amount of flexibility that you don't see with a Roth, that you can pick up in this. But yeah, definitely something to be aware of. But again, the main thing I wanted to get across in my book wasn't all the granular details. It was, here's how a dozen real people have used their plan to their advantage.
Mm-hmm. Yeah, exactly. And go ahead and hold the book up again and let people
Oh
know
yeah.
about it. Taming Wall Street, correct? Okay.
Yes. Yeah.
Absolutely, and that one again focuses in on the cash value life insurance utility, and the other one, I don't know if you have it handy, you can hold up as well. That my first introduction to you was Bridge Over Troubled Wall Street, and that dealt specifically with bridge loans or private loans, and so that's another unusual thing that a financial advisor would talk about, something in the real estate space other than like a REIT or something like that.
Yeah.
How'd you get comfortable? Number one, what is a bridge loan or a private loan, and how do you get your clients comfortable with them?
Yeah. Well, so after the Great Recession, there was such a need to prop up and stabilize the banking system that interest rates dropped to next to nothing. And all of a sudden, it opened up this space where people weren't able to get the financing they needed, especially on commercial real estate, and maybe a business that buys and flips real estate, or leases out space. And so all of a sudden, you had this new blossoming of an industry, which was, private hard money lending, for, lack of a simpler term. But clients that have gone that route, the alternative route, the thing that they've liked about the notes is making sure that there's something tangible behind that money. And I think that's what people like. I think for the most part, people understand real estate. There's a building, it makes money. Um, or that we're going to dump a certain amount of money into it and turn around and see what the market's willing to pay us, and earn a profit. And so there's all kinds of alternative mortgage notes and commercial lending, crowdfunding, different things. I mean, not to I got your book right here, my man.
Right.
And you go through a lot of different options that are out there. But one thing that I will say is, make sure that you're working with a highly reputable company. And there are scams out there, and so you just want to make sure that for sure you have vetted the company, that they are compliant with all of the regulations for raising money, whether they're a 506 Reg D, or promissory note on a smaller transaction. But just making sure that the company is fully legit. I got bit in the butt pretty hard on a group that we thought that they were following all of the regulatory rules, and it turns out that they weren't. And so now there's lawsuits and different things like that. But for the most part, you know, I think most companies are good. They want to
Hmm.
make a
Hmm.
profit and
Yeah.
do well. So I like real estate. I personally, I like rental properties, turnkey. I know
Hmm.
your book talks a little bit about that.
Hmm.
My wife and I have done quite a bit of real estate out of our life insurance plans, which was kind of neat. But so yeah, I'm a fan. But again, you just have to do your due diligence on the mortgage note company or the lending company.
And again, so private lending is an individual pledging money, loaning money, generally at a generous interest rate, 8, 10, 12%, that kind of deal, and the loan is actually secured by some real property, so you have a claim on it. So that's the basics of it, and yeah, it's been a very that is a significant chunk of my investing at this point. Certainly do some crowdfunding stuff, but certainly have found some individual people in local networks to work with and everything. So, as far as if your clients are interested, you have pre-vetted opportunities for them. Is that?
Yeah, I can. I don't handle it myself anymore. I'm trying to focus more on uh, growing my safe money business. But
Mhm.
I've got access to probably 5 or 6 different alternatives that I would be willing to put my own money in. Of course, people would want to do their own research, make sure that they understand, who's handling the money. Is
Mhm.
there a UCC one behind it if things go
Mhm.
south? But yeah, there's a lot of alternatives out there where people can make, like you say, a better than average return and have some form of collateral behind that.
Mhm. Yeah. What about your clients that do want to get into actual physical ownership of a property, a turnkey and whatnot? Do you have turnkey companies? Do you have deals yourself that you try to get folks in? How's that work?
Yeah, we've done a few private deals in the past. We sold them last year and did very well for the client and for ourselves. And then I dumped that money back into my insurance contract. But yeah, I mean, there's a there that we could certainly introduce people to.
I lose you there, Steve? Oh, all right. I think we may have lost Steven there. Hopefully he'll pop back on.
Are you are
Oh,
you there?
okay. Yeah. Okay.
I'm here. Okay, I heard you the
Okay.
whole time.
All right.
I'll back up maybe
Uh-huh.
10 seconds or so. I was just saying that even more than the commercial notes, I like just buying a turnkey rental property or sourcing one yourself, and then from there you can do a private note with somebody that you know. And then they are secured by that piece of collateral and real estate. Um, I, I, uh, I like control. I don't think I'm a control freak or anal retentive or anything like that, but I just think, you know what, I'm an intelligent guy. If I do some research, I think I can do better than average. And so I've liked that. But yeah, with my people, certainly what I do is not where they put all of their money. And so then we brainstorm together. Sometimes they'll pay me a consulting fee to say, look this over. 2 nights ago, we were meeting with a client from the Park City area, and she brought down all these different real estate opportunities, and I just spent about 30 minutes going through saying, hey, when I own real estate, here's what to look for. Be careful of the HOA fee. Your property manager fee looks in line. And here's your cash on cash return. Here's your potential appreciation. Here's how much they're plowing back in for potential maintenance fees. So yeah, we can certainly help with all of those things. But at this point, I'm kind of outsourcing it to people because it's very laborious and hands-on.
Mm-hmm. Yeah.
And I try to be an expert in that. At this point, I don't want to be a jack of all trades. I want to be very good at a few things and go deep on that with clients, but also be a resource to point them in the right direction of
Mm-hmm.
other, intelligent, good opportunities.
Now, physicians have this reputation, uh, maybe deservedly, maybe not, of not being great investors for the amount of money they make. Could you comment on what some of the, sort of common mistakes you see docs and other high income professionals making?
Yeah, I get this question a lot. Are doctors bad investors? And some of them certainly are. I don't think that they're bad investors. They're obviously have higher intelligence than most people. They're better. I guess they're well read, but they've gone to medical school for in some cases over a decade,
Hmm.
maybe even 15 years, and but what I see is they're maybe a little bit too trusting
Hmm.
in their line of work, even in your line of work. I mean, somebody's life is on the line,
Hmm.
and you show up. You're very professional. You're educated. You have experience. I think they think that translates to other areas of their life. And unfortunately, in the finance business, there are schmucks out there that are just looking to make a buck off of you.
Hmm.
And I remember one guy told me, um, doctors are a great group to go after because even if you lose their money, they just go back to work and make more money because they make so much money. And I'm like, well, that's terrible. And I remember when I was in business school, taking an entrepreneur class, and they had, if you're looking to raise capital, go after doctors, dentists, and dummies, and then your family, and then strangers. And I just remember being grossed out by that. And I talked about this in my book, Smartest Doctor in the Room. My grandfather was a dentist, and he got taken advantage of over and over and over again, and it was very sad to witness. And so that really that really shaped a lot of my philosophy when I was in my early. I watched this and I remember thinking, I don't ever want to see people go through this. And so the other thing is, I don't know. Again, I don't want this to come across wrong, but let's say that a doctor does take a loss or is taken advantage of. Uh, what they tend to do more than the general public is they say, "Okay, I got to make up for that," and then they take on more risk and go for a higher rate of return, and the risk starts to compound,
Hmm.
but the returns aren't starting to compound because of the losses every couple of years. And that, unfortunately, I have seen a lot among physicians and dentists and chiropractors, is this, oh crap, it didn't work out. On the next go round, we're going to shoot for the moon and make up for that lost time. And if people could just consistently to return and be a good saver. That's the other thing is, um, what you do as far as how much you put away, that matters for a really long time. I'll give you an example. Let's say that somebody is able to set aside $30,000 a year. Right, a lot of my doctors they put quite a bit of money into these insurance contracts and these other programs, but let's just say $30,000, and then let's say that you could earn 5% on that 30,000, right? So you save the 30,000, a year goes by, you earn the 5%. Now your money's up $1,500, but then next year you're able to dump another $30,000 in. So at that rate, it's going to take you nearly 20 years of interest earnings to match what you could just put aside in savings.
Hmm.
And so becoming a good saver, take advantage of that high income as a physician, as a doctor, and become a really good saver, and then buy assets that will produce more income, like real estate. Put
Hmm.
money into things that are going to be 100% sheltered from a future tax burden. Piggyback, do the two at the same time. So those are a few pitfalls that I commonly see among doctors, is just depending too heavily on rate of return and not enough on themselves to be a good saver, and then chasing returns to try to make up for mistakes or being taken advantage of.
Mm-hmm. Mm-hmm. Great. That's great stuff. We're coming right up at about 30 minutes, or what's our kind of our
Yeah.
soft limit there. Let me ask you, see, where can people find you, and how can they work with you?
Yeah, all six of my books are on Amazon, but they can certainly reach out to me by calling 888-638-0080, or you can just visit my website, yourbridgeplan.com, and there's a tab that says Work with Me. And I'm all about education. I'm not going to put any kind of pressure on anybody. Again, I believe that if you educate somebody enough, it either makes sense and they move forward, or they're educated enough to go, this isn't for me, and we just part ways friends. But those would be the best way to, reach out to me directly, and or visit my website.
Well, we're certainly going to put a link at the bottom of this video to your website, and also a couple of links to your Amazon books as well. Because I think at a minimum, they're well written, concise, to the point, and not a lot of fluff. So
Yeah,
I think
I read Tony Robbins' book, and I love Tony Robbins, and I learned.
oh, the money book,
Oh
that
yeah,
huge
Money
book.
Master
Oh
the
man,
Game, and I
yeah,
mean it's
yeah.
like he put a lifetime of knowledge in 600 pages, but it's like 8-point font, and
Yes.
it took me forever to get through. And so all of my books I've purposely kept right around 100 pages. We're busy. I don't need a bunch of fluffy stories. Here's how it works. Here's some examples. Here's some real life people and what they saw, and just
Hmm.
get right to it. I mean, I don't need all the fluff.
Absolutely.
Yeah. So
Absolutely. Well, it's been great, and I wish you continued success. And we'll be certain to get you back on sometime.
great. Hey, thank you very much. Have a great rest of your night.
All right, you too.